Enjoying two AIs debating the markets every week? Like, share, subscribe, not for the algorithm, for your smarter self, every Sunday. This is the Weekly Market Podcast, zero fluff, just signal.
All right, everyone, settle in. This week in the markets, it really felt like trade diplomacy took center stage, but playing out against this backdrop of a seriously complex economic picture.
Absolutely. You had the new U.S. U.K. trade agreement announced, which was positive.
And whispers, right, that U.S.-China talks might be back on the table.
Exactly. But at the same time, you've got these really resilient labor markets, inflation that just won't quit.
Sticky is the word.
Very sticky. And then emerging signs of, well, some economic challenges too. We saw Europe leaning a bit more dovish, Japan's recovery hitting a few bumps, and China actively stimulating while its U.S. exports fell.
So quite a lot to unpack. For this deep dive, we're going to break it down region by region. We'll start in the U.S., then hop over to Europe and the U.K., touchdown in Japan, and finish up with China.
And after that, we'll look ahead to next week, flagging the key events and data points you need to watch.
Our goal, as always, is to give you the sharpest insights from the week, cut through the noise, and keep you ahead of the curve. Okay, let's jump right into the U.S. markets.
So looking at the main indices, they were slightly down for the week overall. The S&P 500 lost, about 0.47%. Nasdaq down a bit less, 0.27%. And the Dow Jones off just 0.16%.
Minor moves overall, but there's that interesting rally midweek, wasn't there?
There was. That was really driven by the trade news, the confirmation of the U.S. U.K. deal, and importantly, the news about potential U.S.-China talks in Switzerland.
Yeah, you can almost feel the market breathe a small sigh of relief about trade friction maybe easing up.
But then the Federal Reserve stepped in. They held rates steady, no surprise there, but their commentary was very cautious. They really highlighted risks on both sides.
Inflation still being a problem, but also worried about unemployment maybe ticking up.
Precisely. Powell's whole wait-and-see message was very clear. They're not rushing into anything.
And adding to that complexity, we got the April jobs report. Pretty solid, actually. 177,000 jobs added.
And the unemployment rate held steady at 4.2%. So, the labor market still looks quite firm on the surface.
But, and there's always a but, isn't there? Q1 GDP actually contracted, down 0.3%. How do we square that?
Well, part of that GDP dip was put down to a big jump in imports. The thinking is businesses were maybe stocking up before potential tariffs hit.
Ah, okay. So maybe a temporary trade-related distortion.
Possibly. But it definitely raises questions about the strength of underlying demand. Is it weakening, or was it just that import surge? It's not entirely clear yet.
And then there's inflation watch. The ISM Services PMI, that ticked up to 51.6.
Right, showing expansion. But the really eye-catching number was the prices paid index within that survey. It jumped to 65.1%, the highest in over 2 years.
Oof. That's that sticky services inflation everyone's worried about, not what the Fed wants to see.
Definitely not. So the takeaway for the U.S. is this kind of tension. Markets are hopeful on the trade front, but you've got these cooling economic signs mixed with stubborn inflation and a Fed that's clearly on guard.
Okay, let's pivot to the Eurozone. A bit more of a mixed picture there, it seems.
Yeah, definitely. The broad Stoics X Europe 600 index managed a small gain, just under 0.3%. But underneath, you saw Germany's DAX actually jump quite a bit, up 1.79%.
That's strong.
It is. Meanwhile, France's CAC 40 was down slightly, and the UK's FTSE 100 also dipped, which we'll get to.
What was driving that German strength?
Well, we got March data showing German industrial production up 3% and factory orders up 3.6%. That's quite a surge.
Wow. What's the read on that?
Again, the prevailing theory is it's linked to trade, a rush to get orders in and production out before potential new tariffs might bite.
So maybe not sustainable underlying strength, but more of a preemptive move.
That's the big question. Is it temporary? We also had some central bank action in Europe.
Right. The Bank of England cut rates.
Yes, they cut by 25 basis points to 4.25%. But importantly, the vote was really close. 5 members voted for the cut, 4 voted against.
That doesn't exactly scream confidence, does it? Suggests future cuts might be slow going.
It certainly signals caution and internal debate. Elsewhere, Sweden's Riksbank and Norway's Norges Bank held rates steady, but both kind of hinted that cuts could be coming down the line because of all this global uncertainty.
And you mentioned the UK market dipped. Let's focus there for a moment. The FTSE 100 was down about 0.5%.
Yeah, it seemed to react not just to that very narrow Bowie vote, but also some concerning domestic data that came out.
What was that?
The RICS housing survey. It showed a pretty sharp cooling in the housing market. Sales dropped by the most since August last year.
Why a sudden drop?
It seems largely linked to a tax break for first-time buyers expiring.
Yeah.
It just highlights how perhaps fragile household sentiment might be right now.
So for the UK, the BOE is leaning a bit dovish with the cut, but that weak housing data suggests maybe that cut isn't enough on its own, or that the headwinds are pretty strong.
That seems to be the main takeaway, yes. Policy uncertainty coupled with signs of consumer strain.
Okay, moving east now to Japan. Markets there seem to have a better week.
They did, yes. The Nikkei 225 was up 1.83%, and the TOPIX gained 1.7%. A solid performance.
And what was lifting sentiment there?
It looks like it was mostly tied to that improved global mood around trade. You know, the hopes for easing tensions between the U.S. and China, the U.S U.K deal finalized.
So more external factors driving the gains. What about domestically?
Domestically, the picture is less rosy. We saw the yen weaken past 145 to the dollar, which fits with that risk-on global mood where investors favored the dollar.
Okay.
But the wage data that came out for March was quite disappointing. Real wages fell 2.1% year on year.
Ouch. That's significant.
It is. And even nominal wage growth, just the cash increase, was weaker than analysts expected. That's a real problem for the Bank of Japan.
Because they need wages to rise to meet their inflation goals.
Right.
To escape that deflationary mindset.
Exactly. Sustainable wage growth is key to their whole strategy. And on the trade front specifically for Japan.
Yeah.
While the U.S. and U.K. wrapped up their deal relatively quickly, the expectation is that a U.S.-Japan trade deal is going to be much, much harder.
Why is that?
Big sticking points remain, particularly around tariffs on autos and agriculture. Those are tough nuts to crack.
So for Japan, markets cheered the global trade optimism, but beneath the surface, you've got this persistent weakness from stagnant wages and, well, slow progress on their own critical trade negotiations.
That sums it up well.
All right, final stop. China. Markets rallied strongly there.
Very strong week. Shanghai Composite up nearly 2%, CSI 300 up 2%. Hang Seng in Hong Kong gained over 1.6%.
What was the catalyst?
Two main things, really. First, clear signals from Beijing about more stimulus coming. Second, the anticipation building around those renewed trade talks with the U.S.
Let's talk about the stimulus first. What did they actually do?
The People's Bank of China, the PBOC, cut its 7-day repo rate, which is a key short-term lending rate. And they also cut the reserve requirement ratio, the RRR, for banks.
Okay, freeing up more money for banks to lend.
Exactly. The RRR cut alone is estimated to inject over 1 trillion renminbi in long-term liquidity into the system. It's a significant easing move.
And how does China's trade picture look amidst all this? You mentioned U.S. exports fell.
Yes, and this is really fascinating. Exports to the U.S. dropped sharply in April, down 21% compared to last year.
21%, that's huge.
It is, but at the same time, exports to India and to the ASEAN countries, Southeast Asian nations surged.
Ah, so they're shifting focus, diversifying away from the U.S. market.
It certainly looks like a strategic shift is underway, actively cultivating other export destinations.
Makes sense given the tensions. And those U.S.-China talks are actually happening.
Yes, the plan is for Vice Premier He Lifeng to meet U.S. Treasury Secretary Scott Bessent in Geneva this weekend. It'll be crucial to see what tone comes out of that meeting.
First step, maybe. So for China, the takeaway is Beijing is actively pushing back against external pressures with stimulus and trade diversification, but that big question about long-term demand, both domestic and global, still looms large.
Precisely. They're managing the immediate pressures, but the underlying challenges haven't disappeared.
Okay, that covers the regional recap. Let's look ahead to the coming week, May 12th to 16th. What are the key data points we need to be watching?
Starting in the U.S., the big one is Wednesday, May 14th. That's the Consumer Price Index, the CPI print for April. Hugely important inflation reading after the Fed's latest meeting.
Absolutely critical.
What else? Thursday, we get producer prices, PPI, and the usual weekly jobless claims. Then Friday, it's preliminary consumer sentiment and import-export prices. So a heavy dose of inflation and sentiment data.
Got it. How about Europe?
Tuesday, keep an eye on the ZEW Economic Sentiment Index out of Germany. Wednesday is Eurozone industrial production for March. We'll see if that German strength was broader.
And the U.K.?
Thursday is the big one for the U.K., the first estimate of Q1 GDP. Markets will be watching that very closely after the recent soft patches.
Okay.
Japan. Monday brings machinery orders, which is a decent indicator for export trends. And Wednesday, we get their producer price index.
And finally, China. What are the key releases there?
Tuesday, we get both CPI and PPI inflation data for April. That'll be the first real test of whether that recent stimulus is having any price impact.
Right.
Then Friday is another big day for China. Retail sales and industrial production, also for April. That will tell us a lot about whether the easing measures are actually boosting activity.
Okay, a very data-heavy week ahead. So boiling it down, what would you say are the top, let's say, 5 risks or things to watch most closely between May 12th and 16th?
Okay, top 5. Number 1, a U.S. inflation surprise on Wednesday. If that CPI comes in hotter than expected, it could seriously undermine hopes for summer rate cuts.
Definitely risk number 1. What's next?
Number 2, Eurozone industrial weakness. We need to see if Germany's March surge was just a one-off. If Wednesday's broader Eurozone industrial numbers disappoint, it points to wider issues.
Makes sense.
Number 3, China's stimulus traction. Is it working? Friday's retail sales and industrial production data will be the key evidence. Weak numbers would be a real concern about the effectiveness of their easing.
Right. 4th risk.
A potential UK GDP downgrade on Thursday. If that Q1 number is weak, it really amplifies worries about policy uncertainty and how much pressure consumers are under.
And the 5th risk.
Japan's export exposure, Monday's machinery orders, and any other trade hints will show if those global tariff headwinds are starting to actively bite into Japan's economy.
Okay, great rundown. So putting it all together, it feels like, well, we got some hope from potential easing on the trade front. The underlying reality is that global economies are showing more and more signs of pressure.
That's exactly right. Central banks are walking this incredibly fine line.
And next week looks absolutely critical, especially with that U.S. inflation data, and then seeing if China's stimulus is gaining traction and how resilient the Eurozone and U.K. economies really are.
Those data points will definitely shape market sentiment in the near term.
So here's a final thought for you to consider as you track all this data next week. When we look towards the second half of 2025, what's the defining narrative going to be? Is it going to be a story of rebound, maybe driven by trade getting back to normal? Or are we looking at more of a slowdown because these economic headwinds just prove too persistent? Something to keep in mind. Thanks for joining us for this deep dive.
Still watching? Then you're one of us, someone who actually wants to understand the markets. If this helped you think sharper, tap like, share the insight, and hit subscribe. Smarter markets need smarter minds. Let's grow this together. New AI-powered episodes drop every week. Imagine this format: AI-powered, sharp, fast, built around your industry, your firm, your market. For investors, leaders, or teams that move fast, we create custom podcasts designed to inform and impress. Curious? Contact us to build yours. Bespoke, bold, built by Flamingo's Research and Advisory.